Good afternoon, everybody. Thanks very much for joining us. Really interesting session here as part of a series of events that we're doing looking at the outlook for 2021, where we'll be covering some of the global themes as well as also looking at other areas, including in this particular session looking at Europe and the UK. Great panel for you, and also a really interesting presentation just to kick off with Tom Lee from Real Capital Analytics. My name's Richard Betts. We publish a number of magazines, also the Real Asset Day, and run a series of events. We've launched a lot of new initiatives in 2020, special report series, which we'll be doing 5 of in 2021. Also Realcast as a kind of weekly update on the markets. And as well, of course, of around 60 to 70 of these online events to try and keep everybody connected. Welcome if you're joining us in Zoom, and also if you're joining us from the RealX platform there in the exhibition. It's had over 10,000 visitors since we launched it in September, so great to welcome you there as well. Let's just start with you, Richard, just with a kind of, I suppose, brief introduction of yourself and the company.
I'm Richard Pilkington. I work for an organisation called Kane International. Kane were founded in 2014, a private investment firm with 3 principal strategies, all really across real estate. One of those is effectively on the investment side. Second is a lending platform. And the third is we look to back real estate biased hospitality businesses, which sounds a little complicated, but we might touch on that later. Active in the UK, Europe and the US across with a focus on gateway cities. And since 2014, so the inception of the business, we've invested around about $6 billion. My responsibility is to lead the real estate business in Europe.
Great, thanks very much. Oliver.
Oliver Kummerfeld. I'm Schroder Real Estate's dedicated analyst for continental Europe. Schroder Real Estate is part of the wider offering of Schroder's real assets and obviously part of the big listed UK asset manager. In real estate, we've got about 20 billion euros or pounds under management in a range of strategies. Funds, investment trusts, separate accounts. The business continues to grow. We've just acquired a business in Germany. We have a hotel business added and just added a debt platform as well. So that's exciting times. I cover all the sectors across the continental European markets and basically help to define the investment strategies, developing new products, helping the fund and asset managers in terms of acquisitions, disposals, and generally sort of just keep track of the market so they can all make informed decisions.
Great, super, thank you. Vanessa.
I'm Vanessa Muscara from Europa Capital, Head of Research and Strategy. As the name suggests, we are a pan-European investor. We are majority owned by Mitsubishi Estate Corporation, who in turn have an AUM of about 100 billion. We are 25 years young, and we manage a range of strategies from debt to value add to core. And thank you for having me today.
Super, thanks, Vanessa. Jamie.
My name's Jamie Ollie. I'm a principal in Avison Young's Central London investment team. My day job is advising domestic and international investors on the acquisition and disposal of commercial real estate. Also providing portfolio advice to major landowners, occupiers and investors. For those that don't know, Avison Young are a full service line real estate advisor. We've got 13 offices in the UK. We employ over 1,500 people. Globally, I think 100 plus global offices with lots of representation clearly in North America and Canada, as well as Europe and Asia.
Super, thanks very much. Herman.
I'm Cook. I'm working as head of research at Mark Capital Management until the last year known as Meyer Bergman, based in London. And Mark Capital Management is an investment platform, an investment manager providing several platforms of investment, different asset classes active throughout Europe. We are active in the field of urban mixed use, retail repurposing. We are active through Crossbay on last mile logistics. Through Revolt, we are active in, let's say, the alternatives, urban innovation, and we are also investing in residential in several places.
Great, really interesting mix there. Thank you. Let's just start perhaps with you, Ollie, just in terms of the sort of trends for 2021 that you're seeing. Just, I suppose, highlight some of the key things that you're looking at.
Yeah, look, starting with the fundamentals, and I know, it certainly doesn't feel like it, but I think there are lots more reasons to be cheerful. Clearly, vaccinations have started across Europe. That should get us out of the virus, and at some point, restrictions will be eased, and all that consumption, that's kind of come back is kind of will be driving growth. We have a Brexit deal in place, which I think is good news. Some people say, the deal is not as good as thought, but we have a deal. We see a recovery in exports. Europe as a region is quite dependent on that, and the sort of ongoing recovery in Asia is especially helping economies like Germany, which are more export driven. On the manufacturing side, on the industrial side, the EU 750 billion recovery fund will come into play finally. And so far, all the government measures across Europe in terms of support have actually avoided large-scale unemployment or large-scale bankruptcy of companies. And I think that is actually good news. I'm not saying there are no risks going forward, but once lockdown measures are eased, I'm pretty sure we'll see sort of the economy taking off and some of this pent-up demand coming into the market and boosting economic growth.
Herman, maybe coming to you. Obviously, for Mark, there's been a transition, maybe in terms of focus. Logistics, one of those hot topics, but also the sort of focus on technology. Do you see those as the key trends, Herman? What are you seeing as the driving forces for 2021?
I think one of the trends which was clearly accelerated by COVID-19, and which is probably there to stay, that's the further development of multi-channel retail. With the evolution of, let's say, the growth of market share of online retail. In the UK, it's already exceeding 25%, and continental Europe, the most advanced countries, which were obviously in terms of online sales behind, it's now also edging towards 20%. So it's growing fast, and the expectation is that's a factor which is there to stay. People get used to make online shopping. People will also hopefully become used also to combine online shopping with physical stores. But anyway, obviously, a structural trend is a growing need for logistics, urban logistics. So that's where what we see a lot of future scenario in, particularly around the bigger agglomerations, 1 million plus, where there's obviously a need for an extra link between large distance cargo traffic and, let's say, delivery into neighborhoods, delivery into to companies and to households. So a strong base for last mile logistics. And also, if we look, let's say, more to let's say the reaction on COVID-19 and also, let's say, the growth parameters in the economy, it's very obvious that technology is playing an important role in there. We can experience it now with Zoom, but of course with a lot of aspects in life to enable us to keep distance, to enable us to improve health, to enable us to improve comfort, air quality, touch-free environments, and all stuff like that. We see there also in both the economy, but also the real estate market, we see a strong trend of innovation, of technology needed to basically get the real estate market ready for the post-COVID normality.
Okay, good. And Richard, I just wanted to pick up with you. Obviously, there was an element there about the capital flows. What are you seeing, particularly from Kane's perspective, in terms of the capital, what they're looking for, both in terms of sectors, but also, I suppose, whether there's a difference between UK and Europe in terms of their perspective, and whether Brexit has made any difference to that, really?
Obviously, in the last 12 months, capital flows have been significantly down, which naturally means that there's a huge amount of pent-up capital looking to be deployed. But I think that when you look in that space and you talk to investors looking to back management platforms or go into any fund manager or asset manager, they are still very cautious. I think still very thoughtful, and they are very much the appetite is very much down the risk curve. So, down the risk curve and moved very much to, what I'd say very specified strategies. If you say, I want to do a London residential, mid-market level strategy specifically, that's what I want to do, then you may get somebody to back you because they say it's residential, it's the right sector, it's in London, it's in the right city, it's at the right price point, and that is all you're going to do. I think you get a good audience with investors at the moment. I think if you talk about, commingled pan-European funds looking at multi sectors, then the reaction is not as strong. So I think investors are looking for the capital is looking to be in much more specified strategies. I think tighter geographies, tighter sector focus, and I think it's kind of understandable. The turn-off word is clearly commercial, because there is a mixed view. I think as Tom highlighted earlier, there is a mixed view about that. But I think that I think the environment, as Ollie just said, the environment is better. There are reasons to be positive. That people do see a kind of light at the end of the tunnel. But I think for now, everyone is personally still very, very. I think everyone's very, very cautious, and I think we've seen every time somebody's predicted a bounce back after 3 months, whether it was middle of last year, whether it was Q3 last year, or Q4, or now Q1. I guess our view would be you won't see a huge amount of activity, probably until the beginning of Q3, and whether that be, capital flows, whether it be occupier movement, etc. I think investment volumes. I think it is going to take until that time before people feel confident to start pushing the capital out there, and I think there'll be a big challenge for the capital, because it's great to say we want to be in the term's beds and sheds, isn't it? Now we want to be in beds and sheds. Well, both those markets have got in certain elements of those markets, have very high barriers to entry. You could argue they're massively overpriced. In logistics is being priced 4 to 5%, depending on where you are across the UK and Europe. And if you're looking at institutional style residential, as in the typical build to rent, that's kind of being priced in a similar way. And it's interesting because investors are looking for growth. And I heard something yesterday that logistics occupiers are looking for cost savings. But all the capital wants to go into those two sectors. So it's kind of an interesting conundrum, really, that it's easy to say, but is it really that easy to do?
Yeah, and it's interesting that it seems to have moved now from beds and sheds to beds, sheds, and meds. That's what I've been hearing. Jamie, go ahead, Tom. Yeah.
We operate as sort of a group email address for our clients asking us questions about the market, and I've never seen such a rush of people asking about life sciences in the last 6 months. So from all around the world, we've had clients ask us for data on life sciences, who's buying, where's the market, how big is it, blah, et cetera, et cetera, et cetera. But actually, in reality, it's really very small. If you look at the amount of investment stock out there, it's about 1% of the global market, 1.5%. So beds and sheds are more of an opportunity than meds, which I think are still niche. Sorry, just coming in there.
Okay, good. Thank you. Jamie, I just wanted to pick up with you. Obviously, because your focus is central London, especially, and since we're focusing on the UK and the perspective within Europe here as well, I suppose, what have you been seeing over 2020, and how are you seeing the sort of 2021 as we move into it? Glass half full, glass half empty. Where are you?
I think obviously 2020, we've seen lots of the stats come through, and I thought that Tom's slides were really helpful, sort of giving a view on that. And obviously, from a central London perspective, first half of last year was pretty slow and not great at all, and very low transactional volumes. Started off actually quite well, and then clearly from March onwards, it got a lot worse. I think the thing about London is that the activity, there is a pent up demand still. There has been a huge amount of weight of capital looking at London over the years, and it still looks at London despite all the headwinds and challenges that we all know. I suppose last year, if you look at it on paper, you would say the year-end figures of circa 9 billion versus 13 billion in 2019 are actually quite good. And actually looking, I think the West End was very little difference. So on those sort of standalone, that looks quite interesting. And I think I was quite, I know that we're all going to talk about the flight to income and quality, and that's definitely a theme today. I think what surprised and probably encouraged me last year also was the amount of investors looking at value add and looking at opportunities with a shorter term risk, and also the interest out there for development sites in central London. I'm not going to say there are a huge swathe of activity, but where there is activity of a site that's really exciting in a great location, and I'm going to use this, I'm going to use the transport, Crossrail, Queen Elizabeth line, which everyone, clearly is well versed in. But in and around those locations, there's still very strong demand. I think we've just seen at the end of last year, it was in the press, I think last week, that a UK fund has entered the market in forward funding on a development site in Bermondsey. So right just behind London Bridge Station, which is really exciting. So I think it's probably, for me, it's how the market did actually work and the activity. But I do think this year going into it with lockdown 3, and I agree with Richard's point and Tom's points, and that it's going to be a sluggish 6 months in terms of activity. We're not seeing a great deal of new stock come to the market. And if you are going to do that, there has to be a real reason why you want to do that. But there is demand for income. There is demand, as I say, for development sites to do in the obviously into the future. But it is slower. It is slower at the moment.
Okay, good. And Vanessa, just looking at, I suppose, UK in the European context. I mean, Europa are investing across Europe. How do you see the UK, particularly within that perspective? And I suppose also just pick up some of those points from Jamie and anything else that you want to. I mean, is there comparative value in London versus, Berlin, Paris, etc.? How are you seeing that at the moment?
I guess it's getting increasingly challenging to read some of those PMI sentiment numbers, which sort of plunged at the beginning of last year. But what I see is that historically, PMI figures have really reflected political uncertainty. So taking the UK as an example, markets don't like uncertainty, but following some political events, say in 2016, the referendum, or the 2019 elections, PMI numbers in the UK tended to recover. More recently, it's almost as if there's been a shift in interpretation of those PMI figures, and they're not reacting to political uncertainty anymore. Certainly in the UK, I think the PMI composite figure was 50 in December, and then it's dropped down to 40 more recently. And so for me, that's more a reflection of vaccine rollouts. And looking at it into more detailed, if you split the composite PMI into, say, services and manufacturing, there's this wonderful stat I've seen just looking at services PMI, which for the UK is actually picked up in January, and it's a forward-looking one because of the relatively more vaccines rolled out as a share of population, and that slowly seems to be recovering both for the UK and Eurozone. But coming back to relative value, even though in this era of market cycles being less relevant than structural changes, I guess we can still say that London, at least, is very much driven by tight fundamentals, as Oliver was saying earlier, but also absolutely by global relative value. So you're seeing a spread in London still of 400 basis points as opposed to likes of Paris, which is less than 300. And also, in my 15, 20 years experience, you've seen London always reinvent itself, and we're seeing change in occupier profiles, not only financial services, even though we wait and see what the deal will look like in end of March, to say other occupier profiles like TMT, things like this.
But there clearly is a yield differential if you look at, prime office Berlin 2.65%, City of London 3 3/4. Jamie, is that about right?
Sounds about right. 3 3/4
yeah.
to 4. Yeah.
So and now that some of the Brexit uncertainty has been removed, I would expect more international capital sort of to commit again, and that'll certainly drive down some of the yields in the UK, and there might be a ripple down effect from London into some of the regional market. My question always is in terms of the underlying fundamentals in the occupier markets, is Berlin at 2.6-5? Is that justified versus a 3 3/4 in the City of London? And sometimes I think the occupier market in some of the continental European markets is looking a little bit more stable, is looking a little bit better at the moment. In Berlin, the vacancy rate went up from 1.8% to 2.8%. Massive pipeline. But even then, the forecast suggests you end up with a vacancy rate of 5 or 6% in 3-4 years. Is that something to worry about? Probably not. Whereas in the City of London, at the moment, it doesn't look great. Vacancy has gone up. I think there's lots of space as well available for subletting. And you see more supply coming, and you have a little bit of an uncertainty still about, as Vanessa pointed out, the deal with the European Union is a deal that is good for the European Union because it covers goods. It's not so good for the UK per se. It's good that there is an agreement on goods, but for the UK, an agreement on financial services would have been, at least in the short term, maybe a better deal. So I guess financial occupiers in the city or in London, might sort of sit back a little bit, maybe look more at the operations in the European Union before they sort of expand. But I fully agree with Vanessa. London has always reinvented itself. It's a global center. But at the moment, maybe there is a bit of a performance differential over the next sort of two, maybe 3 years.
Jamie, I'll come back to you on that in a minute, just in terms of how you're seeing that reinvention side of things, because you're obviously very close to that. But Richard, I just wanted to pick up with you. There's been a lot of discussion around regional cities, and Oliver just mentioned it there. Do you still see the kind of, because I know that Gain has had very much a kind of gateway cities, winning cities kind of strategy. Has that been altered at all by the health crisis and the idea that people may be moving into regional cities? What's your sense of that?
Taking that particular point, I think that the point of what we call kind of gateway and challenger cities, and that being, in the UK, London being the gateway, maybe Manchester, Birmingham is a challenger city, or if you're in Spain, Madrid is the gateway, and Barcelona is a challenger city. I guess fundamentally these are cities that have the resilience to withstand, the cycles, the downturns, etc. So I think from our point of view on the equity side of things, in the strategies we followed to date, I think the answer is no. We would stay on those strategies. I give you an example. We have been focused in Poland, in Warsaw and in Krakow. We've been focused on commercial and residential. We've been very successful with residential, and we intend to continue that thing. When you look there, there are many residential opportunities in Poland, but we've kind of dismissed everything but focusing on 3 cities: Warsaw, Krakow, and Wrocław. And I think that you've got to stay very disciplined. I think the point about people, perhaps, if we're talking about the UK or European cities, the idea of people moving out of the cities, and I think that's potentially a trend, but it will take a long time to come. I think that it takes a big. We've been in an environment for the last 10 years where people have moved back into cities. So to suddenly go, we're going to move out of the cities. Well, where are people going to go? And will it offer them we know outside of central London, typically, depends on, what demographic you are, but what accommodation exists in the same style. If you live in an apartment building in London, if you want to move out of London to, Birmingham, will you still find the same quality and volume of apartment living? You won't. You gas wherever you want. It kind of isn't there. But I think where we have probably followed and are following the out of London theme is on our lending side. Where we are, through our lending platform, our larger lending platform, which has typically done the bigger 75 million, type of loans, through to the platform, the Fortwell platform we have. That is right across the country and is predominantly biased to residential. And I don't think that has been there anyway, despite what's happened over the last 12 months. But I think increasingly that we probably see that as a growing area where that risk profile is we're happy to be a lender into those positions, but perhaps not to be the equity.
I agree with Richard in terms of the the cities. I think the pandemic has not killed the city at all. I fully agree that sort of at Schroders we call it the winning cities. That those cities will continue to prosper. I think they have the infrastructure. They have the education element that draws people in. It's the business communities, and this is where the growth industries are really physically located. And the fact that there has been a little bit more in the papers about people moving out, I think that's a bit overblown, because I think the the kind of people that are actually able to leave the city is actually fairly limited. It's not going to be the pensioners or who might depend on healthcare in the future and need to be closer to maybe doctors. It's probably not sort of the graduates and the students, because the universities are still there, and this is where sort of their jobs are, where their networks are, and I think it's a very small group actually, if you dice it down, who actually have the money and sort of the ability to move out of the city. So for us, it's pretty clear. We still focus on what we call our winning cities.
Yeah, I would agree on that one as well. I mean, obviously the gateway cities and the capital cities, they're all very resilient. Of course, at the beginning of COVID, we saw a trend that a little bit like a hypothesis that smaller cities were easier to manage, were easier in times of lockdown, etc. But I think when we look on the map, I would say all the cities these days are hit pretty heavily, basically, and have been going through different cycles of the pandemic. However, what you see when you look, let's say, to the core cities becoming ever more expensive. You can see that particularly in France. You can see that also in the US, also elsewhere in Europe, where you see that actually for certain economic sectors, like particularly creative businesses, startups, etc., that often the core city might be too expensive in terms of office space, in terms of residential space. So particularly when you look to France, there you see that cities like Bordeaux, Toulouse, Lyon, they are doing relatively well when you compare it to Paris, because they do draw quite a bit of new business, but particularly also linked to the fact that, of course, the country is well connected through a high-speed rail system. And I think also what we also see, that's particularly also a thing we see at the moment in the Netherlands, obviously suburbanization, people leaving the city and obviously moving somewhere else, that's a big thing. But let's say people anticipating that instead of going to the office 5 days a week in the future, let's say they go 4 days or 3 days, that people tend to accept a longer commute time. Of course, you can read it as leaving the city. On the other hand, you can also see that as they stay connected to the agglomeration, they stay connected to the big city, and obviously that big city continues to be the focus of the business and the economy.
Okay, good.
Yeah.
Jamie, I just wanted to pick up with you that idea of London reinventing itself. I mean, we've seen obviously, particularly in the investment banking sector and the finance sector, jobs already moving actually since the referendum have gradually been moving over a period of time. What's your sense of that? Are we seeing different occupiers coming in? Is there a changeover? I mean, how flexible is London in that way?
The outcome of the Brexit deal and its impact on the city we'll have to see how that will be felt, and it's going to be a very interesting year, etc. I think what we sort of just stepping back and looking at it just from an occupation as a London advisor, I think since the GFC we've seen, and if you talk to any leasing agents on major schemes, we've seen the financial sector type occupier, that demand reducing or headcount reducing. So if you've got any friends that work in any investment banks in London, there has been headcount reduction for some time, before the Brexit referendum and before where we are now. So I would say, whilst there's still a very important component of the tenant mix, the mix of London has changed, as it has changed everywhere. So a lot more tech, clearly in media. If you look at occupiers, professional services have been pushing on last year. Lawyers, US law firms in particular. I think Latham Watkins have just signed a pre-let on a large building in the City of London. As we said, education is a massive part of the London economy now in terms of attracting the talent, but also occupier now. I think Tom's point around meds, us agents, we love to talk about anything new in the market, but we've just seen a transaction close to Euston. I think it actually exchanged last week, which the buyers of that are talking around life sciences and going forward on that basis. So I think we've seen a trend really with the financial groups changing their headcount. And I think I don't know the exact figures, but I can remember being sort of spoken around looking at two different occupiers, say Deutsche Bank, who back when I started work, they occupied, over 2 million square feet in the City of London over a kind of campus, lots of different buildings. They're now pre-let a new building, a land securities development at Moorfields, which I think is around 750,000 square feet. And that's going to be their new home. When you compare that to Amazon, who, when I started work, didn't have a footprint clearly at all in the city, they now occupy, I think, over double that in the City of London in shiny grade A office buildings in interesting locations close to, the Crossrail. But that just shows you the change of the sort of tenant audience. But don't get me wrong, financial services is very important. But it's not just all about banks now in London.
Richard, I think it's worth, there's also an interesting point about, about occupiers and the way in which occupiers will occupy space. So talking earlier about, people being interested in development opportunities. So why are people in London looking for development sites? They're looking for development sites because what they're saying is the investor market doesn't want to take the risk. So someone needs to, the more private investor market needs to think about taking that risk. So what do? You buy the site and you develop to core, and then you take that risk to allow that investor to come in and buy the product. So if you've been in that development space, which we have, and I have in a previous life, it's interesting how things have changed over the last 10 years, and this goes to the way occupiers are using buildings. So if you think that the BCO guideline 10 years ago was 1 to 10. And over the period between then and now, Brookfield particularly pioneered this. It's been driven down to designing buildings for 1 to 6 occupancy. 1 to 6 means you can't have a desk bigger than 1.2 meters, etc., etc., etc. It's almost sort of trading floor standard. And I think what's really interesting, and this is certainly what we think, and we think that we have this view right across Europe, is that whilst people might, is the office dead? In our view, absolutely not. We'd have to say that because we've got a pan-European office portfolio. But the point is, I think that people were occupying these buildings down to a 1 to 6 level, jamming people in. I don't believe anyone will be able to treat their people like that anymore. And I think effectively what will happen is you'll have to move back to a more comfortable 1 to 10 because people will want more space. They'll want to sit apart. The pandemic will be a legacy of it. People will feel more. They want a bit more hygiene. They want a bit more breathing space, etc., etc. And I think what will happen is, you'll take something like a Deutsche Bank in 750,000 square feet, and all of a sudden they'll turn around and say, we could do with another 50,000 square feet. We could do with more space. Yeah. We have a portfolio in Madrid, and we are already seeing that with a couple of big occupiers who were actually seeking to downsize. We're now having conversations with them about upsizing, and it's absolutely driven based on them saying, we can't occupy the space in the same way. So I think that, it's a slightly different spin on it, but I think in London, one of the things that will, if we lose some of the occupiers, I think some of the existing occupiers who are wedded to London, who have been packed into smaller spaces, will need more space. And that will be a kind of change that happens in London as a result of the pandemic.
I actually, thank you for bringing that up. That is exactly sort of the point, that I'm behind. The office is not dead, and the discussion that you've seen, some of these headlines, are so not differentiated. There are even differences between sort of different industries. A law firm occupies space differently than a manufacturing firm or an engineering company, even within functions within a business. HR has a different profile than sales, and so on and so on. So I think you need to be looking precisely sort of what part of the office will be for what sort of function. And then you come to the conclusion very quickly, also if you listen to occupiers, that the office is an absolute core element of the business strategy. It's not just a place where people go and then they work there. It's part of a brand. It's part of an HR strategy, and so much more than just an envelope where something happened. And in terms of workplace change, I think it's more sort of evolution than revolution. Yes, the evolution is a bit quicker with COVID, has been probably accelerated. But when I look at Tom's chart, seeing sort of offices, like quite down there, I'm not concerned about offices. I think offices have a great future.
I was going to say a quick point. I think one of the problems with this is the way the debate gets framed. And I guess some of this is to do with like the way the press write about it. It makes a good headline to say the office is dead. Whereas actually, I think anyone in real estate wouldn't say, of course, that's not the case. But I do wonder whether there will be some downsizing, because some of that would be driven by decision makers on the top floor of buildings. The chief financial officer, if they look at their office portfolio and think, well, we've had a successful 12 months of working remotely. Can we, move around people? Can we, tell people to only work 3 days in the office and 2 days at home? And will that result in a reduction in footprint? And I think if the boss, it comes up between, on one side there's productivity, on the other side there's kind of the cost and fixed costs of having an office. And if you can make the productivity work while reducing the fixed costs, that's clearly going to be quite attractive to to a CFO of a large business.
I think
So
that's right, Tom. But I think you hit the nail on the head. If you can make the productivity work, and it's interesting. Does anyone really believe, if you put a poll to, ask everybody who's on this call or listening in, do you honestly believe that people are fully productive at home? In some sectors, maybe. I would argue most sectors, no. They're distracted. The internet goes down. Somebody knocks on the door. People are homeschooling. The dog's barking.
For me, it's more about
I'm
sort
not
of
a
the interaction that happens in the office. It's like you hear someone talking about something on the phone, and once he hangs up the phone, you go over and says like, "What's that about this and this?" And he says, "Yeah, oh, we have a problem with this." And you say like, "Look, we sorted this, yesterday, or we did that for a different client." And this is sort of the interaction and sort of the innovation that happens. You hear from someone who is just launching on a new idea, and you go like, "Yeah, I can help you with that." That's the kind of stuff of missing. And in terms of cost saving, I mean, if you cannot weigh up sort of cost savings versus innovation and productivity.
Indeed, HR, branding, identity. Also, I see it in our own office, particularly for the young people working in our office. For growing their career, for learning, the office is really, really essential. I can imagine the role of the office to change. I can, for instance, imagine less focus on workplaces, more focus on meeting places, social places, learning places. However, when you look to the market, I think what is going to be, let's say, a thing in the market is obviously companies, decision makers. I think they will be more concerned about the quality of the building, the health of the building, hygienic issues, all kind of stuff. I think in that sense, of course, COVID-19, we are learning a lot of that. And I think I can expect quite a bit of changes there. So obviously the standard of quality of the building and the possibilities to adapt that building, let's say, to new post-COVID guidelines and needs, I think that will maybe be a differentiating factor in the market. And obviously that also offers opportunities for developers and investors. I think we are going to have quite an upgrading task ahead of us.
Some offices will be more fit for purpose, and hence you'll see the yield differential to offices that are sort of not fit for that kind of purpose.
Yeah, I think Oliver, that's interesting.
Vanessa,
I was going to say it's technology that's driving flexibility of space. So if there's one stat that gave me comfort last year, is apparently we spend 90% of our lives indoors. So I guess what will change is just the way we use it. So I think it's almost as if we need a new sector called mixed use, something like that, and not be too wedded to just the office sector. Certainly, it was interesting watching some of the investor intentions stats from INREV showing that offices still remained among the top 3 preferred sectors among institutions, among investors. So it's just a matter of finding the way of what's driving what we do within it. So I think I mentioned venture capital flows was mentioned earlier. I think startups were only funded by venture capital 20% 10 years ago. Now it's more like 85%. And that's changing different occupier profiles. You're seeing the rise of TMT and the way they use space. So there's more to see it from that perspective. It's not necessarily office, call it mixed use.
No, absolutely.
Sector.
I've got a question. Thank you, Amy, for this, which is quite interesting, actually. Which is, do speakers think the way the public sector will interact with real estate markets may change post-pandemic? Vacant units in town centres, high streets, will they become more proactive in terms of real estate investment developer, or at least connecting with real estate investment and developers? Does anybody have a kind of view on that?
If I may start, I mean, I think absolutely yes, and particularly on 2 sides. First of all, in most of the large cities, we have an issue on affordable housing. We have an issue on accommodating essential workers, policemen, teachers, etc. In the regular housing market. So in order to keep those cities working, in order to keep those cities managed, in several countries, I see an increasing trend of intervening either, on the rent regulation side or on the supply side by triggering additional developments, etc. And then secondly, when you go to a lot of town centers, the whole shift to multi-channel retailing, vacancy in high street areas, obsolete retail space, in some cases, fantastic buildings which need new functions. There, at least initiative, but probably also intervention, also understanding of a shift from retail to, for instance, mixed use, what is needed from a point of view of zoning, planning, different stakeholders, etc., together. I think on the town center side, if municipalities want to keep their town center as, let's say, living room, the lounge of the city where people go, where people meet, I can imagine an intervening, coordinating role to bring stakeholders together to facilitate investment, to facilitate development is going to be needed.
I was going to say the same as well. For as long as fiscal policy and monetary policy is kept loose, is keeping us in jobs and interest rates are low, that's really underpinned residential values, but also in turn widening the gap between renters and buyers. That said, it's also preventing investors investing in the sector as a result of these rent controls. So maybe there's an argument to say, do we need our industry to consider it more of a social infrastructure and have some sort of government agreed index linked long-term leases for us to give us comfort to be able to intervene in the sector and meet the supply gap?
I think just quickly, Richard, on this, because the question is about local authorities, and we saw quite a trend for local authorities in the UK anyway, acquiring space using public works loan board capital from the government. So borrowing very cheap, borrowing cheap money and then investing. Some of this investment was done on their patch, but others were investing off their patch. So something like Spelthorne has been quite busy acquiring real estate. But I think there was a bit of a meme in the market about a lot of these smart owners and agents were selling these councils pretty crummy secondary retail properties. So Croydon has come a cropper lately on the basis of the assets that they acquired. So I think the councils clearly want to have a stake in their public realm, and they think by acquiring properties they can do that. But I think there's clearly got to be quite careful about how it's done. And certainly there's been some that have come a cropper as a result of the investment as well, the acquisitions decisions they've been making.
Okay.
Richard, I don't say one short thing. I mean, there's always been an opportunity for the government and for local authorities to work in partnership with developers, and there are some great examples, but there are many, many more not great examples. And the problem is, at the central government level, there is no decision whether you're devolving responsibility, you're doing this, give the mayor the right to call something in, and it's just his decision what to do. The thing that does need a revolution. I mean, there's no question there's a demand for it. Key workers are going to become even more important in the future off the back of the pandemic. You need to house them. The social infrastructure needs to improve. We've got to build hospitals again. We've got to do all this sort of thing. But the way in which government funds are pushed down to local authorities and the way the planning system works, developers just won't engage in it because it's just so prohibitive. And it's just extremely difficult to build those public-private partnerships. So it needs a revolution somewhere, or some massive kind of. I always look at the LDDC back in the 90s, the 80s and 90s. To me, was a revolution. They created the LDDC to take it offline of central government, to take it offline of local planning. And what did you get out of the LDDC? Canary Wharf and everything else that's there. So it can be done, but. Sounds slightly passionate here, but I think it requires a revolution. The way it is today, it's just not going to happen.
I wasn't expecting it to require a revolution when I started this, Richard, but I like that. I've got a question here from Marcia. Thanks very much. Good to see you, Marcia. And also one from Bilal from earlier. Marcia's are investors now more open to invest in health and well-being certification due to the demands of the market users to be able to work in a safe and healthy environment? So that's one. And there's also one from Bilal, which we can pick out as hospitality, I suppose, but he's particularly talking about the Italian market, which is what sort of percentage discount range from pre-COVID valuations do we expect to see for prime and central, prime location hospitality assets? If anybody wants to answer on Italy specifically, feel free to. But otherwise, I guess in general, if anybody's got any views on those.
Look, maybe just touching on hotels, if you like. We've set up a fund which we call it a whole European Hotels Operating Fund, and Italy is part of that geographical scope. But what you do here, I think you underwrite a sort of a somewhat slow recovery with gradual reopening, and what we do there is we not just buy the real estate, we actually buy the operating company as well. But we also have a specialized team, right? So you take physical charge of the asset. They might change the layout, they might change the interior, they replace the management, they change the franchise. So it almost feels like a business investment. And I think there will be some distressed opportunities in the hospitality market. But you need to be an expert in your field to be able to sort of really jump on them. I can't comment sort of specifically on Italy, but what you'll see in general is that domestic travel will be something that comes up, will restart soonest, and then you'll probably see sort of more inter-European travel and then the international travel. So it will be a gradual trend, and you just need to make sure when you look at hotels that you know exactly where are the people that use these hotels are coming from. Business hotels, business travel will probably be lower in the future, or will start longer to recover. Unemployment, if we see a spike, will undermine consumers going on holiday. So it is not an easy sector. And as I said, I think you're underwriting here sort of a bit of a slow recovery with gradual opening.
So in order of recovery, it's probably going to be Germany first because they have the highest share of domestic tourists.
France is not a bad example as well, though Paris depends a lot on sort of really international travel from, North America and Asia.
So France would struggle slightly more in that sense in terms of the hotel market. Okay, good. Are there any particular... I mean, we're actually up against time, but I'll do a quick 5 minutes just in terms of, I suppose, what we see as the big investment opportunities, and if there are any key trends that we haven't already picked up on so far. So maybe let's start with you, Vanessa, just in terms of, I suppose, a key trend, whether it's repositioning, whether it's, whatever it might be, whether it's more core, whether it's more opportunistic. What's your sense of that? And also, where do you see the sort of the best opportunities over 2021 or going forward?
Let's start with trends, I guess. Technology and the way we use real estate, which in turn will impact flexibility of space. We talked about mixed use already earlier. The next trend will probably be the shift in our portfolios from retail to other sectors. And then it's a shame we didn't speak about ESG. I think we need to, ESG will impact more and more our portfolios. There'll be a rise of requirements for certified buildings, I'm sure. And it's for us researchers to make the case for them selectively, making sure that they outperform. And then in terms of opportunities for 2021, I guess anywhere where you see tight fundamentals, which we've spoken about earlier, and low pipelines versus history. So still logistics and living. And there's a range of opportunities within them, because you could go for core opportunities and well located in cities, in core cities, but also mispricing opportunities. So for value add, I mean, certainly we've seen non-core values. If you look at the INREV universe last year, dropped by about 10%. So if we are going to use real estate more flexibly, then I'm sure there's a number of mispricing opportunities to change non-core assets back to core.
Yeah, okay, great. Jamie, what are you seeing in terms of opportunities?
Points there around the flight to quality. So if obviously you can find that right asset, the quality, the income length, etc., I think that's very exciting. And I think values and pricing on those assets, Oliver and I were talking earlier around prime yield in the city. I think most people agree they will sharpen for the very best assets and the longest income. I think we are going to see that this year, and that will come through. I think also the point around development for how people occupy buildings and the exciting locations, I think that's going to continue. I think it's interesting. I think the repurposing that we've touched on as well. I think we're already seeing it with Debenhams stores in sort of greater and central London. I think we're even seeing some of it on Oxford Street. I think that's really interesting where that goes. And I think that probably ties into the point around more regional and local authorities. But I think that area is really interesting. And I think we're going to see, I think there's going to be some big impact investing going into those areas this year. It's not something I'm an expert in or my locality, but I think regionally in the UK, I think we're going to see some big groups go into that.
Great, thanks, Jamie. And Tom, anything that you're seeing in terms of your data that suggests where the opportunities might be?
Well, in terms of our data, we just see people buying beds and sheds. So whether the opportunities are there is, I guess, is a question we've already discussed. In terms of, I mean, I just jotted down a few points. I think Vanessa's, we didn't talk about ESG, but I think that's clearly a big push for property owners, especially those with investing institutional capital. I think a lot of them have got goals to be carbon neutral within next 10, 15, 20 years. So I think repurposing buildings, as Vanessa said, is going to be a big opportunity for people. I think maybe selectively hotels. I know there's clearly issues affecting the hotel sector at the moment, but I do think people's appetite for travel will probably come back if the pandemic is brought under control. And then anything sort of experiential as well, experiential retail, food courts, as Jamie mentioned, the conversion of some of these Debenhams buildings into this kind of mixed use experiential type of space, because I think people's appetite for socializing hasn't gone away. It's changing.
Looking to, let's say, the last year, and obviously probably also the coming half year, I mean, Tom's data confirmed it. We've been very active in last mile logistics, cross bay, and also residential beds and sheds. It's telling the story. It's possible to buy. It's possible to sell. It's also possible to lease. We even concluded a lease deal on the last mile facility without anybody of the tenant seeing the building before signing the contract. I mean, lot is possible. So there we obviously have been very active. In the longer run, and particularly the fallout, also the need in town centers, the fallout in the retail, department stores, of course, a lot of opportunities in repurposing, mixed use, urban, and obviously all these asset classes linked to the possibilities to upgrade and integrate technology fully in them.
Okay, great. And I agree, actually. I mean, in terms of we didn't get to the questions around ESG, wellness, but absolutely. And we're also picking up a huge amount of focus on impact investment, both from the capital side, but also an increasing focus from the asset management side as well. Oliver, what's your sort of top tips for everybody?
Well, I think it's a land of opportunity, as you hear. It just sort of goes down a little bit to what risk are you willing to take and what returns are you expecting, or what can you live with. ESG we'll see throughout. I think any sort of commercial decisions will be underlined by ESG. For me, it's mostly about future-proofing your investment. Your tenants want it, your investors want it, and in all honesty, you probably should want it as well. It just makes sort of like a sense. In terms of sectors, logistic is still a growth sector. It's transformed. A logistics asset 5 years ago or 10 years ago would have looked very different to the ones now. I'm concerned about sort of the pricing. I think Richard mentioned that as well. So maybe, what about a little bit more light industrial? Yields are a little bit higher. You can probably get long leases if you have very good businesses in there. So that's maybe something to look at. Residential, of course, also in the space of social housing. But as I said before, I have a bit of a passion for offices. I think there's lots of opportunities in finding the right sort of offices. And look, retail is not that either. I mean, there are parts in the retail market that perform very, very well. It's always different in different countries. But, retail warehouses in Germany or grocery retail, I think is definitely something to look at. And country-wise, we are spoiled, as a region. My favorites at the moment are the Nordic countries, Germany and probably the Netherlands, just because they've held up quite well in terms of economic performance and, the fundamentals in the market in terms of, supply and demand. But, France is definitely up there. It's worth looking at Spain and Austria. So it's a land of opportunity. It just comes down a little bit to your risk appetite, your availability of returns, and your access to product. Okay, great. And last but not least, Richard.
I think I look at it and think, what are we trying to do? We're trying to line capital up with opportunities, and with occupiers, really. So you're trying to appeal to all the different audiences. So, number one, I think going forward, it's got to be about specified strategies. You've got to be very clear, to what are you looking to deliver, where you're looking to deliver it, and who is it for, and whose money are you using to do so. And I think that, yes, Gateway City will always play a major part in it. But where would you, how do you go about it, to Oliver's point, and how do you, what would you put your money into next year if you have the opportunity to do so? Well, I would say it is about office buildings, but they have to be smarter. They have to be tech-led. We have to recognise people will occupy them differently. mixed use retail. Everyone's kind of mentioned retail, but any, out there today, retail that sits in prime locations is a bargain. And if you can convert that retail into some kind of mixed use offering, you're going to create huge value over the medium term. So I would be focusing around that kind of strategy. I think out of town office we haven't talked about. I do think out of town office will be a winner off the back of the pandemic, and I do think, notwithstanding not having a particular regional strategy, I think that regional offices like that will be winners. And then the beds and sheds world, definitely, I think there is high barriers to entry, but on the bed side of it, I think it's about widening your perspective as to what that means. So senior living, absolutely. I think affordable homes, getting down, if you're in London, to the £500 a foot, if you can deliver that product, that is a huge opportunity. And the other kind of not mentioned sort of asset class in there is service departments. I think service departments are a big opportunity for the future. I think that will become a real trend, particularly in the UK, where we have a very limited amount of that kind of supply.
Thanks very much to all of you for your views. Thank you for joining us as well. If you're in RealX, do go to visit the exhibition. That's all waiting there for you. Interestingly, Ollie, you mentioned there France and the Netherlands, and we've got sessions on both of those next week as part of the Outlook series, as well as one session which has only just come in actually. So we're doing that on Thursday afternoon, which is looking at the sort of top 10 global themes, and there's a super presentation there and a panel to follow that, so please do join us there. In the meantime, thanks very much for joining us, and look forward to seeing you at the next one, and thanks very much to the speakers. Thank you.